Hi, and thank you for joining us for today's webinar with Joe DiNapoli, the practical application of Fibonacci levels to investment markets. I'm Betty Smith. I'm Vice President of Communications here at CQG. And today's webinar is special in that the presentation part is pre-recorded, and we have Joe on the line live in Bangkok at 3 a.m. to answer questions at the end of the presentation. So I just wanted to let everyone know the format for today. So I will welcome Joe shortly. I think he was still attending to some open orders. He wanted to record the presentation so that at 3 a.m. his time, he could be as clear and sharp on what he's presenting on his DiNapoli studies for you. And as always, we will take your questions at the end of the presentation, but please use the Q&A feature of WebEx to submit your questions at any time during the presentation. If you have any technical issues today, especially regarding the audio, please use the chat feature so that our host can get with you right away. And let's see, I think that I can move on to the introduction of Joe. He is the president of Coast Investment Software and has been trading actively for over 40 years. He's a longtime CQG customer and a big fan of ours. His studies are available in our flagship product, of course, the CQG Integrated Client. Joe's book, Trading with DiNapoli Levels, has been translated into 9 languages and counting, and Joe's a very respected speaker and teacher around the world. So we are just absolutely thrilled to be able to offer this webinar today. And with that, we'll move into the presentation.
Traders, welcome. Now, this is being recorded from Bangkok, mid-August 2011. And yes, we're having some pretty wild markets. And when you have wild, crazy markets, you need a good trading strategy. I've been trading all through this every single day, ever since this craziness started. And I'm a little bit further on in the presentation, I'm going to tell you why the craziness started. But I've been trading every day. I've been doing very well. And I attribute it to the techniques, the kind of techniques that I'm going to be showing you. There's something in common with what's going on here now and what went on during a flash crash and what went on in 1987. I was trading at all those times. Actually, I missed the flash crash. I was out in one of the local bars. I wished I hadn't missed it, to be quite honest with you. But, you know, who wants to miss the Olympics of trading? Not me. The common thread running through all of these different times in the markets is illiquidity. It's illiquidity, and the illiquidity is being caused in large part to the high-frequency traders. Now, when you signed up for this event, there was a page, and there was a link on that page that told you that you could go to an article I did, and the article had to do with illiquidity situation that we're in now. And I highly recommend, I very strongly recommend that you read that article. There's also on the CQG site, there's a link to my website where there is an unedited version of that same article. That article came from a presentation I did at the Traders Expo in November of 2010, and that was entitled, Is Armageddon at the Doorstep Again? Please, for your own benefit, find it, listen to it. There's some stuff in there that is very, very pertinent to what's happening in our markets today. Okay, let's get started. There's a disclaimer down at the bottom of the page. That's the typical legal stuff. I want to give you a different disclaimer, and it's very important that you take it as gospel. My main purpose is not to do any harm here. We've got an hour to talk, and I got an hour to show you a few things, maybe a little less than that. And I can't give you an entire trading strategy in that period of time. I can give you some tools and some ideas about how I trade, which will get you out in front of the market. According to the Hippocratic Oath, do no harm. I don't want you to go off thinking you can be a DiNapoli trader after hearing a 45-minute or 1-hour presentation. That is impossible. Now, what I can do is give you a good, solid idea of what leading indicators are in general and what DiNapoli levels are in particular. This presentation is not a complete trading approach. we're going to cover how to get solid and reliable support and resistance levels. And what we will not adequately cover is the context for the trade. Now, the context of the trade is telling you whether the market is going to be going up or down. DiNapoli Levels, position yourself within that context. In other words, it gives you exact entry points, exact exit points, and it gives you exact stop-loss points. Now, this is very critical because if you know the market's going up or down, you've got some great indicator that allows you to determine this. DiNapoli Levels give you exact positioning points, entry, exit, stop, loss. You need this because even though you might know the market's going up or the market's going down, you know, how many of us get stopped out before it goes the way we expect it to go? So DiNapoli Levels is all about positioning yourself. It is a leading indicator. Now, I've developed several leading indicators in my trading career, and the first one was the Oscillator Predictor, and that was done back in 1981. Now, the reason that I developed leading indicators is because back then in the 70s, I was using, you know, moving average stuff, which might get you into a long move, but before you got out, you know, you'd give back so much of what you had gained that you'd just go crazy. So the first thing I developed was the Oscillator Predictor back in 81. And let me just show you what the Oscillator Predictor can do for you. Now, nobody ever accused the British pound of not being volatile. The Oscillator Predictor is a set of volatility bands, and a simple click on CQG will give you these volatility bands. Now, they're not some standard deviations, 2.5 times or whatever. You know, it's not that simple. It comes from a study called the detrended oscillator, and it's a derivative thereof. This volatility band has some amazing properties. I mean, it can get you very, very close to max overbought, max oversold. It'll really nail highs and lows in the market. It is primarily used for taking profits as opposed to getting into trades, but there's a variety of ways one can use it. The main reason I'm showing it to you is because I want you to see that it leads the market. See, everything I do is leading indicator based. I want my indicators to get out in front of the market because I want to know what to do tomorrow, next week, or in the next 3 minutes. I don't want to, you know, I'm not interested in what I should have done, you know, a month ago. The next thing we're going to discuss is the MACD predictor. I developed that in 2003, and the MACD predictor has some incredibly amazing properties to it. The most simple approach or way to use this thing is to use it just as a trend indicator. And as a trend indicator, you can see if we jump forward here to Morgan Stanley. By the way, I love trading Morgan Stanley. It's been very good to me. And we've got enough volatility with this stock to make some money. I trade a lot of stocks, triple ETFs, you name it, I trade it. If you put on the MACD predictor, you will notice that it contains the trend, you know, reasonably well. But the thing that I want to show you about the MACD predictor is that it gives you a number, and this number is a day ahead, an hour ahead, or 5 minutes ahead. It is a leading indicator. See that? And that leading indicator tells you at what point the trend is going to change. As you'll see as we get further into the presentation, that is very important to understand where trend change points are, because what we're going to be doing is buying and selling retracements of a move. Now, as a trend indicator, you can see the frustration one might get. You get this big up move like this, and you have to wait for here to take your profits if you're trading a typical lagging indicator or typical moving average system. But with DiNapoli Levels, let me just give you a preview. With DiNapoli Levels, you can come in here and you can do some calculations, and you can take profits way up here. That's what it's all about. Leading indicators allow you to take profits. You see, you get this point way down here at point C. None of this has happened yet. Okay, let's go back to the presentation. All right, in 1985 to 1987, I developed a study called DiNapoli Levels. DiNapoli Levels is a subset of Fibonacci work. Now, many of you would have the following comment. How do I know? Because I've been teaching this stuff since about 1986, 1987. And the comment that I get is that, hey, Joe, I've used Fibonacci work before. Sometimes it works, sometimes it doesn't. How do I know when it works, and how do I know when it won't work? Well, pretty simple. First of all, you don't use standard Fibonacci work. Use DiNapoli levels. DiNapoli levels are far more accurate. It's a subset of Fibonacci work. It's an advanced form of Fibonacci work. So be specific and use the high-quality stuff. Don't use all the stuff. Secondly, use adequate context. Now, that is just absolutely critical. We've just had a break in the markets in August, tremendous down thrust. Now, if you were buying retracements of the previous up move, you'd get your head handed to you. However, if you were selling retracements of the down move, there were plenty of times that you could have positioned yourself short in this market, accurately taken almost no heat, and been able to get nice profits. This was the case on a 5-minute chart, a 3-minute chart, a daily chart. Now, the difference between DiNapoli levels and standard Fibonacci work is quality, clarity, and ease of use. If you've got something that is easy to use and is clear, you can stick to your trade plan. You have enough confidence to pull the trigger. When you guys ladies start trading in any kind of size, what's going to happen is you're going to get nervous. Your finger's going to shake. It's going to be hard to press that button. If you've got a clear plan, if you've got something simple and easy to follow, you're going to be able to move. Without it, you're going to be frozen. Now, we're going to hit and touch upon context just a little bit because it is so important, and then we'll get to the main topic of this presentation. You want to buy dips when the context points higher. You want to place stops. You want to have predetermined profit objectives. What you always want to do is cut your profits. I know it doesn't sound like what you've heard before, but it's what you should do. Volatile markets have predetermined profit objectives. I'll show you how to get them. In a down move, you have the context pointing lower, place stops, have predetermined profit objectives. You sell rallies back. If you sold rallies back in this last crash we've had, from the beginning of August to mid-August, you sold the rallies back. You'd have made a ton. Now, you have to know how to position yourself within that rally so that you don't get stopped out before it goes your way, and that's what it's all about. Now, what I use for context is basically 3 things: thrust, the MACD predictor, and certain patterns. There's 9 patterns in my book, Trading with DiNapoli Levels. About 4 or 5 of those patterns I use all the time. When they show up, I know whether I want to be a buyer or I know whether I want to be a seller. Now, if you happen to have something you've used, you know, the flaming fractal dodgy method of directional analysis, and this thing's told you, hey, the market's going up, or hey, the market's going down, and you want to bolt onto that, my DiNapoli levels, my positioning tools, that's perfectly okay. Just be sure that your context indicator is a good one. Leading indicators. Here's what a leading indicator is going to do for you. Aussie-US dollar. We've got a high. The high is sitting here. How would you have known that that high would have occurred ahead of time? That high came in at approximately 57.27. This is a daily chart. You create something called a focus number, and you look back and you try to get the DiNapoli level reaction points. Now, you can't because you can't look back far enough. It's a daily chart. In order to come up with this number, you have to go to a higher time frame. Higher time frame. Look at the monthly. Focus. Multiple reactions, DiNapoli levels, and this thing is called a confluence level. I'm going to get back and I'm going to show you exactly how I do this. But for now, the idea is for you to simply follow along and see the general idea of a leading indicator. You see, it's way back here that we get these levels that we can act on forward in time. And it doesn't make any difference whether it's a 1-minute chart or a monthly chart. The stuff works exactly the same. The confluence level came out at 57.09 to 10, and I believe the number that we were looking at before was 27. Let's talk about the difference between DiNapoli levels and standard Fibonacci analysis. And to do that, we need to look at retracement and expansion levels. On the left-hand side, there's a whole variety of retracement ratios. On the right-hand side, expansion ratios. The expansion ratios go on infinitum. I only use certain of the retracement ratios, and I only use certain of the expansion ratios. Now, I've determined this through many, many, many years of research. I use no Fibonacci numbers. I use no arcs, no circles, no time counts. Now, you can spend your life trying to figure out how to do Fibonacci time counts. I've certainly spent enough years. I've given up on it. I do not think it's accurate enough for me. Instead, I'll use one of my context indicators, let me know when to get into the trade, and then I use my Fibonacci analysis to position myself within that move. Fibonacci regression, Fibonacci clusters. I do not use most Fibonacci clusters. I use 2 retracement ratios. I use 3 expansion ratios, and it's the way that you use these things that makes the difference. No, I don't use 0.5. No, I don't use 0.79. All this stuff simply adds more confusion than it is worth. Now, let's say you're using the 2 major ratios, 0.382, 0.618, and you have a price chart. You're going from point A to point B. You take the high, you take the low. You don't take the inverse square, the cube hourly close on a logarithmic chart. Just keep it simple. It's the high and it's the low. Vertical distance, horizontal distance does not matter. The market comes up to a 0.382 ratio of the entire down move, there will be resistance or selling. If the market comes up beyond that point, there will be additional resistance or selling at the 0.618. We are not certain that this will stop the market, but there will definitely 100% be resistance at those points. This is why it's so important to understand the context for the trade. If you have an up move, you have support at a 0.382 and a 0.618 retracement of the up move, approximately 40 to 60%. One way to trade this on a confirmed move up would be to buy above the 0.382 node, put a stop below the 0.618. Very, very basic stuff. Now, let's take a look at the current market and see whether or not this may have been of some value. This is a monthly chart when it ever comes up. See, here's the benefit from trading from Bangkok. You have to wait for the internet. And even with this as a mitigating factor, I'm able to do what I'm able to do. All right, here's a monthly chart. And this is a 0.382 and 0.618 retracement from the 2009 low, March of 2009, at a level, by the way, that I predicted, up to the high. Now, this is really quite easy to do. If you use the retracement tool, simply click over here, hit the focus number, hit the reaction, double-click down here, and you get the 0.382 retracement. That provided support for the crashing market that we just had. Oh, and let me digress. I said I was going to tell you one of the reasons why we had this crashing market. Well, one was the illiquidity. But here's what happened. In the middle of August, in the beginning of August, we had a trend change. We had a confirmed trend change down. This is the MACD predictor. It's a monthly chart. We have a trend change down through this thing. Europe had already given a break of the MACD predictor on the monthly chart. It was confirmed in July. It was also confirmed on the Shanghai index prior to this one. This is actually not confirmed because we're still in the month of August, but it looks pretty doubtful that it's not going to confirm. At any rate, the point is that this indicator, this MACD predictor, told you that this was going to, look at this, we've had a move up since March of 2009. We have never broken the monthly in that entire point, the entire time until now. And that was one of the main reasons why we had this problem. The reason for the extent of the move has to do with illiquidity. Nevertheless, the 0.382 node held. Now, let's take a look at the daily chart. Here's your highest, here's your lowest low, here's your highest high. Let's open this up a bit and get the retracement tool. Click the focus number, click the reaction number. Now, where did this market slow down? Where did this market stop? A little bit more on that later. The point is that this is an extremely effective method, even if you're using just basic Fibonacci analysis. All right, let's talk about expansion analysis. Now we're using the expansion ratios that I have found most valuable. And what we're doing is on any move from a point A to a point B, retracement at point C, we are going to extend down according to these ratios. We take the vertical distance between A and B, we multiply it by 0.618 and get the COP, contracted objective point. The vertical distance between A and B, multiply it by 0.1, we get the objective point. The vertical distance between A and B, 1.618, we multiply that out and we get the XOP. Now, some of the popular Elliott wave guys do not extend from point C. They extend from point B. Do not do that. Extend from point C. It is far more accurate. In an up move, A, B, pull back at C, we can get, likewise, a contracted objective point, an objective point, or an expanded objective point. These three locations give you your profit objectives. Highly accurate. Which of the three locations that you use depends on the context, beyond the ability for me to discuss in this presentation. Now, here is an advanced concept. If this doesn't make you money, I don't know. I don't know what will. You've got an up move here. You've got a set of retracements, 0.382 and 0.618. Basic Fibonacci analysis. Now, we have a down move, A, B, C, OP move down, and the OP move down comes in the vicinity of the 0.382 retracement. This is what's called an agreement level. Now, let me show you how that worked out in the current world charts that I have been trading. If we take a look at this daily 240 chart of the E-mini, we can do an A, B, C. Now, look at that. It's not an accident that this is what held back this market. At least it held it back to now. And here are some numbers that will hold back the market, assuming the market gets that high. And we're going to show you how to do multiple expansions. Here is your first ABC, which we did on the previous chart, right there. You can do a multiple ABC, A, B, C, and you get another number. We have a 0.382 resistance fib node here on the previous chart, not shown in this chart, right there. We have an expansion at 225 and another expansion up here at 2475. This is why the market is hesitating there. Now, if you've got a market that's hesitating, this is a 240, we were looking at 240 and 30-minute charts. If you've got a market that's hesitating, and you know it's going to hesitate because of the DiNapoli levels that are there, how much money do you think you can make on a 5 or a 3-minute chart? Normally, in my scalping accounts, I'll get 2 to 14 trades in a day. I've been getting 30 and 40 trades every night scalping. Now, I don't just scalp. I take positions down, but I'm talking right now about scalping trades. I'm showing you how you can use this stuff to help you, whether you're a scalper or whether you're a position trader. You know, I realize everybody tells you they got the best system and the best approach in the world, and you've got to make a decision. You've only got so much time. You know, what are you going to study? What aren't you going to study? These DiNapoli levels have allowed me to predict myself or one of my clients or one of my DiNapoli experts on the forums have been able to predict major market turning points, a few of which are listed below, and literally thousands, I'm talking thousands of market turning points on lower time frame charts. Now, while we're at it, I'm recording this segment on the following day. I just want to show you what happened to that expansion level that I made for you yesterday. I was trading this thing last night. So just take a look at what happened. This is the chart last night. Here is the resistance level, and here is the market action. And so you can get some appreciation for how significant that action was. This is what it looks like on a 5-minute chart. And this was the DiNapoli level resistance, and that's what we have. Now, we're currently trading the night session as I'm recording, and if you notice, the low was considerably lower than the low that is shown on this chart. So this is just an example of what you can do with these numbers. Since your time is valuable, here's what I suggest you do. What are you going to study? What aren't you going to study? Go to our website, pull up the testimonial section. You will see years and years and years of testimonials from clients just like yourself describing in detail, how much benefit this approach has been to them. You should always be suspect of any approach or any system that is constantly, cooking the books, changing the numbers, changing the inputs to the equations that they use on different time frames or for different commodities. We don't change anything. Everything is the same whether you're trading a 1-minute chart or whether you're trading a yearly. Now, if you're trading a yearly chart, you may have to wait 6 years for DiNapoli level to be hit. If you're a scalper and you're trading a 1-minute chart, you may have to wait about 6 seconds. I want to show you something very interesting. This is a DiNapoli level right here at 139.398, all right, approximately 139.400. Just keep that in mind. There are other DiNapoli levels here also, but right now I want you to focus on this one because depth of market includes that number. These other numbers are too far out of range. Now take a look at the bids and the offers here. Typical bid or offer is in the hundreds or in the 1,000s. Take a look here, 700. 800, 1,300, 1,400, roughly 1,400. Now you get almost 100% increase. You get 100% increase on this thing because this is the DiNapoli level. That is where the resistance is. This stuff works. Let's get into some advanced techniques. Assuming you have a weekly chart, and when you look at this weekly chart, you've got one low, one high. If you have a 7-day week and the markets trade every day, don't some of us wish that, you would have, or you could have, a single high but 2 reaction lows. So the lower you drop your time frame, the more reaction lows you're going to get. Keep that in mind. With advanced DiNapoli levels, what we do is we take the top of the chart and we call this the focus number. We would call the first reaction, reaction 1, the second reaction, reaction 2. From reaction 2 to the focus number, we can get 2 DiNapoli levels, 0.382 and 0.618. From reaction 1 to the focus number, we can get 2 more, 0.382 and 0.618. If you get a close proximity of a 0.382 and 0.618 fib node, this is called a confluence area. Here's an example of the confluence area that we hit when we were in the middle of the warning of the downgrade for the U.S. Treasury market. And you will see that the market came down. This is a daily chart. The MACD predictor was on a sell signal, daily chart. The weekly was also on a sell, not shown. Monthly had not gone into a sell, not shown, just the daily chart. We came right down a confluence, and even though the news was very negative and we had a negative trend on both the daily and the weekly, you can see that the confluence level did support. What I want you to have in mind that if you were trading a low time frame chart and you knew this number ahead of time, and you would know the number ahead of time because it's a leading indicator, you would have had a chance to make a considerable amount of money on a short time frame chart. Here's an example of monthly on the British pound US dollar. You can see that the confluence level supported well there. If you have a market with a focus number and 3 reactions, you can get 6 fib nodes. And in this case, I don't know what happened to my other confluence level, but you can get 2 confluence levels. 1 confluence level here, another confluence level there. A beautiful way to trade this thing is to buy the market just above 1 confluence level and hide your stop below another confluence level. Confluence levels are far stronger than individual fib nodes. Each one of these things is a fib node. The reason it's numbered 1, 2, 3, not 1, 2, 3, is because the fib nodes that you run into on the way back down are going to be created from this one first. That's why it's number 1. Here's an example of COMEX Gold. This was after we hit the projected high that we had. This was on a yearly OP at 1,026. We came back down to this confluence level, down to approximately 740, and we had a nice bounce off that level. Actually, we're at almost 1,800. This is a picture of the confluence level that was produced. Notice that these levels, okay, all these levels came about when we were at the high. So this thing literally led the market by about a year because it's a yearly chart. So we hadn't even hit the confluence level at the time that this chart was screen printed. And notice that we had a confluence level here between 72.77 and 68.47. And these reaction lows went all the way back to the depression low back in the 30s. And this is how we came up with this confluence level. And, of course, you know that the market ultimately did support at this level and came back up and made new highs. Notice that if you're using the CQG software in the DiNapoli studies, that these things are colorized. 0.382 nodes are red, and we've got purple for 0.618 nodes. This makes it very easy to identify confluence areas. Quality, clarity, and ease of use. That's what the whole thing is about. Allows you to stick to your trade plan. If you use standard Fibonacci studies, you get something that looks like this or like this. What you must realize about this approach is that when you create these fib nodes, and you'll realize this after you've had some time to study this material and internalize it, the reaction low that creates the fib nodes is all important. Now, this is in chapters 9 through 11 of my book, Trading with DiNapoli Levels. It is critical to know what reaction low is creating the fib nodes, because they don't create fib nodes of equal strength. And when you've got a picture like this or like this, you don't know where in the hell things are. Additionally, let's imagine for a minute that this is a 5-minute chart. Actually, why don't we just go to a 5-minute chart? And this is of the E-mini. If you make a set of fib nodes, now how you select these things is to look for the more prominent reactions. That's one hint on how you select them. But there is a lot to the selection process, more than I can describe here in such a short presentation. But here's what you need to understand about these things, is that when you do this, if the market makes a new low, or when the market makes a new low, all these things move with it. If you have standard software, that's not going to happen. You have to redraw all these things. Let me show you what I would be doing for my trading tonight. Very simple procedure. If I did it right, it would be even simpler. Now, take a look at this. Here is the projected COP low of 117690. Take a look up here. What do we have for a low? 117675. Now, if you think this is an accident, I feel sorry for you. It's not an accident. This is the way things go. This is a picture of a 30-minute E-mini, and I'll show you exactly, a pit session only. I'm going to show you exactly what I would do for my trading tonight. Focus number, pull it back. Here is a fairly prominent reaction low. Okay, reaction low here, reaction low here, reaction low here. All right, now what I do is I do some expansions. A, B, C. Now, I've got an area right here of agreement down at the 1164 area. And it's going to be a very significant area of interest for me in my trading tonight. So will this area be at approximately 1171.26. We've been focusing a lot on the E-mini. Gold is in the news, and the good thing about gold is you don't have the high-frequency trading computers screwing things up, decreasing the liquidity the way we have in the stock market in the E-mini. And I thought it might be interesting to some of you to see how you would get into this gold market. It's been just about a straight-up move. And what you can do is let's drop to a 30-minute chart. We get the retracement tool out, and we look for prominent reaction lows. We got one here, we got one here, we got one here. And as you'll learn, if you study the book Trading with DiNapoli Levels, there are hidden reactions. And I'm going to click on this level to show you one hidden reaction. All right, double click, and the series is formed. This is what's called a DiNapoli Level series. Now, as you can see, we have a confluence level coming up right here at approximately 1848 to 1850. Now, this is the MACD predictor, not part of this presentation, so let me just get this off of here. This would be an area of interest. I'd be very interested in buying this market, assuming we get down to this level. Now, another thing we can do is we can see if we have an agreement area. A, B, C. Now look at this. You have an OP. You have an OP move at 1854, and you also have a confluence level down here at 1850 with an XOP down here at 1847. Now, that's a very wide range for me. I mean, if I'm going to be getting into something, I want to get into it right. And I would probably, given this analysis, want to be a buyer somewhere in the vicinity here of about 1850. Now, you must understand that if this market makes a new high, what it will do is it will change all these numbers. And if you have the DiNapoli level studies, the numbers all change with it. There's no need for you to recalculate this stuff. Now, I keep track of a lot of stuff, and the only way I can keep track of all this stuff is because I have a nice piece of software called CQG that organizes it all for me. This is magical. I mean, this is fantastic. This gives me the ability to trade a whole bunch of stuff, not just one or two things. I set alerts at these DiNapoli levels, and when they go off, I go look at it and see if I'm interested in trading it. Now, if this entry is like, here's a range of support. That range of support is a little bit too wide for me. Instead of doing this, let's drop down to a 5-minute chart and see if we can get an entry that would be closer to the market, so we would have more of a chance of getting a fill, and if we might be able to find something a little bit more accurate. Accurate in terms of narrowing down the areas of interest and not making them so wide. I don't like to risk a lot of money. All right, I'm going to go to a 5-minute chart. So let's drop down here to a 5-minute chart. Okay, now we can see what it is that we want to see. Let's get an expansion series on there. And let's see if there is a reasonable place where DiNapoli studies are going to be effective. And you will see right here that there is an area of interest. We have an OP here at 1857. We have a 0.382 fib node at 1858. Now, I gave you a very good hint a little while ago that the reaction numbers, and this is why you have to learn about the DiNapoli levels. You can't just start doing it. The reaction numbers impact, that's a pretty good reaction number. The reaction numbers impact the quality of the fib node. Anyway, in a big bull market like we have in gold, you can come back here, you can get long in this area, and you can put your stop below, say, this area of confluence or below the XOP, and the chances of you making money are extremely good. My suggestion is if you think this is useful, if you think it's worth investigating, don't go pioneering. Spend some money. Get this book. This is the Bible. It's been translated now to 9 different languages, more licenses to come. It's worthwhile. You can order it from our website, fibtrader.com. There's other items at fibtrader.com that you can order as well. It's just crazy to try to approach this thing and try to actually do it without adequate instruction. We have a mechanism for a free trial of both the CQG software as well as the DiNapoli level studies, but my recommendation is you don't get the free trial until you've had an opportunity to really understand what the material is about. But when you get to that point, you can email me, cisinc@fibtrader.com. There's details involved. I don't want to get into the details right now. Before I close, I want to make a comment about the CQG software. And I'm not saying this because I'm doing this recording and doing this presentation for CQG. This comes from the heart. High quality graphic software is a critical part of your success trading these markets. And these markets are not easy. These markets are tough. CQG makes the best software on the planet for this kind of trading. There isn't even anybody that comes close. Now, maybe if your name is, Mr. Computer, and you're so computer literate that you can wear a blindfold, maybe something else is going to work. But for most of us, for me certainly, the ease of use, the quality of the data, it is incomparable. I've been using CQG software since 1984, 1985, right in that area. And when we used to do shows at the in Las Vegas back then, geez, trying to remember the name of them. Oh yeah, Futures Symposium International. That's what it was. Jake Bernstein, Larry Williams, myself. Great shows. 500 people crawling around at 5:30 in the morning trying to learn something about trading, lifetime trading. We only have so many terminals, and everybody. That's what all the experts wanted. That's what they wanted to teach with. They wanted something high quality. Everybody competed for the use of the CQG terminals. This was the old TQ 2020 software. CQG is simply the best. My studies are available on a couple of other platforms, not very many, and the studies work well on those platforms. But without doubt, CQG, best software on the planet. That's what I use today, and without it, I simply couldn't do what I do in the markets. As always, pay attention to the disclaimers. This is a risky business, and I guess I'll close this thing up right now and get ready for some questions. Thank you.
Well, thank you so much, Joe, and thank you so much for the lovely unsolicited compliments about CQG. If CQG itself would luck, I'm sure it would.
Betty, can I ask you to hold 1 second, please?
Oh, sure.
Would it be okay with you if I took just 2 or 3 minutes and showed the current gold market, because it just everything that I was talking about 2 weeks ago when I made this recording is happening. I mean, it's perfectly. So the viewers will be able to see this, live time if I'm competent enough to show it to them. If you remember the chart in the S&P when the when the MACD predictor on the monthly chart was penetrated, we had huge follow-through to the downside. All right, now we're looking at daily gold. I want to show you how this MACD predictor works. Take a look at gold and take a look at what happened when the MACD predictor, and that was just hit today. We had the exact same kind of action. What this tells you is when this sort of thing comes up in the market, you don't want to be a buyer. You want to sell all retracements. Now, gold is not the E-mini S&P. This is not a monthly chart. Gold is in a bull market. This is a daily chart. I do expect throwback rallies and strong ones, and maybe even a new. But there is something else going on in gold that I want to show you that I might be able to show you now if I'm lucky. This is the gold quarterly chart, and once the data comes in, remember I'm in Bangkok, once the data comes in, I want to show you how a yearly projection helps you to trade on a daily chart. This is actually going to be a quarterly projection. Anyway, this is a quarterly chart, and you can draw an ABC. The A goes all the way back here to the lows back in 1999. You've got a high there at B. You've got a low at C. This projects all the way up to 1943, almost hit the other day. Now, when you get that close to an, that's very serious. You can expect one hell of a reaction back, and of course, that's what we've got. Now, to make it even more clear, if you throw the oscillator predictor on here, you will see that we were major overbought. We were major overbought prior to the move down through the MACD predictor. So all these things, they just added up, and they said this was going to be a hell of a move down. I kept hearing people on CNBC talking about this or that being the reason. Here's the reading. The MACD predictor, whether it's on a 20, a 30, a daily, weekly, or a monthly, there are computer-generated trades, and there are really large funds. And there are people out there that watch this thing, And when this sucker comes in, it can be very big and it can be very hard. And we can go to questions.
We do have a question from Carlos, and he says, great stuff, Joe. Is there a discretionary aspect to your methodology and these trading times of high volatility?
Well, there's a discretion to it 100%. That's what keeps it working. I mean, there is no trading system in the world that's going to keep working unless there's some discretion built in, because orders just get bunched up. So there's no, definitely discretion. The more volatility, the better. I mean, if you've got high volatility, that's terrific. Now, the thing you've got to watch out for is that when liquidity gets low, I know low liquidity creates high volatility, but what the desired way to trade this system is with adequate liquidity. The numbers come in beautifully that way. When you get low liquidity, you're going to get the numbers are going to come in, but you're going to run through the numbers sometimes, and it's a little bit more difficult.
I do have one question coming in right now, and this one's from Donji. What other fib percentages do you use, and why do you not use the fib time projections?
I don't use any other fib ratios than the ones I showed you. When you start doing multiple reaction lows and you start doing things like agreement levels, it becomes impossible to keep track of the numbers when you start adding in other ratios. So the benefit to reward drops off considerably. What you have to realize is that when you become more professional, you start trading in large sums of money, you need absolute clarity. And I absolutely keep my charts. If you were here and you look at my charts, you're only going to see a couple of indicators on them. You're not going to see stuff plastered all over the charts. So this is what I need, clarity. And I don't know anybody that can use my methods with more ratios than I currently use. That's one thing. And I don't use Fibonacci time projections because I've never found them to be accurate enough. I've spent years and years of my life playing around with that. And no, they're not accurate enough for me.
All right. And a question from John. And his is, where's the disconnect as to why traders who do learn this, but they still can't make money?
Well, there's a million reasons. Just a minute, I'm getting an alert. Excuse me. There's a million reasons why you might not make money. I mean, the psychology of trading is a deep issue, and one of the things I offer is a trading course, and in that I get into the psychology of trading quite a lot. The problem is that most new traders are lied to. You're told that having a lot of margin is a good thing, where in fact it's a bad thing. In other words, if you know what you're doing and you use high margin, you're going to go down. You're going to blow out. If you don't know what you're doing, no worries. Use as high a margin as you want because you're going to blow out anyway. If you know what you're doing, however, you want to keep the bet small. And convincing people of that simple fact, might take years. Unless you come from India, and those people seem to just be born with money management techniques. Now that's just one aspect. There's the ability to stay with your trade plan. There's the ability to pay up for decent software. You don't have decent software, you're not going to make it. Myriad of reasons why you might fail.
All right, I have a couple more follow-up questions. What determines whether you take all in, all out, the COP, the OP, or the XOP?
Well, that's about a 2.5 hour presentation. It has to do with the context of the trade. To give you some idea, if you've got preceding thrust and the thrust is dramatic, you would tend to go for an OP or an XOP. If the move is more sloppy, you'd be satisfied with a COP. But, there's a lot of factors that bear into this. It also might depend upon whether or not you have one of my patterns. Usually, if you're using a pattern for a context, you're going to get a deeper profit objective. It just might be a good moment here because I'm sure I got some new listeners for me to to mention the following. Some people are not mentally equipped to handle leading indicators. I mean, for me, it's absolutely no problem. I don't mind a market coming at me, no sign of it turning, and for me to enter an order. That is not an issue. I've been doing it for many, many years, and I know it's the best way I can trade. But there are other people that just need to feel comfortable. They need to have other traders around them. They need to be a member of a group. You know, when I go out a lot of the times, I go out alone. I like it. You know, I enjoy that aspect of life. If you need reassurance, and a lot of it, you just go find some other method. You know, just use the MACD predictor and be a trend follower. That'll work.
All right. And Joe, in the interest of time, let's take one last question, and then we'll wrap up. Does your book enable a novice trader to have enough material to develop trading strategies on DiNapoli levels?
100%. That's why it's been published in so many different countries. That's why, you know, no matter where I go around the world, people are, go to my testimonial page. Don't take my word for it. You know, at one point we had so many testimonials, the girl who was putting them on the website quit. It was, you know, so you don't need to take my word for it. I mean, I've changed lives, and that's why I do this. I don't need the money. So
well, it's a good time for me. I know you've mentioned your disclaimer several times. It's probably a good time for me to mention the CQG disclaimer that we don't give trading advice, but we were absolutely thrilled to host you today and have the presentation. Well,
you know, I want to say one thing more about CQG and yourself and Amy. And also the attendees. A lot of the attendees out there are people I know, and I do appreciate the support, and I'm here to help you. If you need it, I'm here to help you. Of course, it has to be on my terms and my time, but I'm here to help you. It is delightful for me to be able to do something for CQG. I mean, just to pay back a little bit is just, you know, I couldn't be happier.
We really appreciate it, and we really appreciate that you're up at what I believe is now 4 a.m. So thanks, everyone, once again for joining us. And as always, we will have the recorded webinar available for you in a couple of days. It will be available on our news site, news.cqg.com. So thanks, everyone. And Joe, have a good evening.
And I will say Salati Krap to you. That's good night and tie.
All right. Thanks again.